Aritzia has been one of the TSX's hottest stocks over the past year, and it's still soaring after releasing its latest quarterly numbers. On January 9th, the company posted its Q3 numbers, with its growth rate looking impressive. For the most recent quarter, which ended on December 1st, the company's net sales rose by 11.5%, totaling just under $729 million for the period. What was even more impressive is that its comparable sales growth rate was 6.6%. Comparable sales growth tells investors how much the company's existing stores are growing. It excludes the impact of new store openings, and thus can be a much more useful metric to gauge how well the business is growing. It's a solid rate given that many consumers are cutting back on discretionary spending these days. Many businesses are struggling to generate low single-digit comparable growth, but Aritzia is doing just fine. Another number that looked really good this past quarter was the company's net income. At $74 million, it was up 72% year over year. That's a huge rate of growth in the bottom line. The company is not only growing its business, but keeping its expenses under control, which is a great sign for investors that it is scaling efficiently. And if that pattern continues, then that will help bring down the stock's earnings multiple, making Aritzia an even better buy in the long run. The big reason the business is doing well is due to e-commerce and its expansion in the U.S. market. Sales in the U.S. were up by nearly 24%, totaling $404 million. On the Canadian side, things weren't as great, and sales were actually down by less than 1% to $325 million. But with the U.S. market looking strong, Aritzia can still be poised for much more growth ahead. For Q4, the company projects that its sales will be between $830 million and $850 million. That's an increase of more than 15% from this past quarter. The company is also eyeing more growth in the long term. It says it is planning to launch an enhanced international e-commerce site to reach more customers. And it's also going to roll out a mobile app. Both of these moves could help accelerate the company's growth rate even further. Shares of Aritzia are so hot they're now at all-time highs. Last year, the stock rose by 94%, and year-to-date, it's already off to a flying start, up around 28%. The obvious concern for investors is whether it's too late to invest in the stock and whether it has gotten too hot. Right now, its Relative Strength Index, or RSI, is at about 77. That tells investors that the stock has become overbought. But as you can see in the past year, being overbought is nothing new for Aritzia. But the value is definitely getting a bit rich. The stock is trading at almost 60 times its trailing earnings. And its forward earnings multiple of 25 is also a big high. Aritzia could be a good buy in the long run, but I'd hold off on buying the stock given how hot it is right now. Plus, there's the threat of tariffs in the U.S., which could adversely impact Aritzia's business that investors shouldn't overlook, especially given how important the U.S. business has become for the company. Canada could impose retaliatory tariffs, and it could be a messy situation all around. I think there's going to be room for a correction because of the tariff risk, the markets as a whole being overheated, and the stock's valuation being as high as it is. Even if you like Aritzia stock for the long term, it may be a good idea to wait because there could be a correction this year, and it could be a big one depending on how the markets do and what impact tariffs have on its business.